Hi, and welcome to the short summary of the main principles of the standard IAS 21, the effects of changes in foreign exchange rates. I am Sylvia of cpdbox.com, the place to be if you want to understand and apply IFRS easily. I have created the IFRS package, teaching you to apply IFRS, helping you to pass your exams, get your CPDs if needed, and lots of other great stuff for students and professionals. So you're welcome to check everything out at cpdbox.com. So in today's world, the entities carry out their foreign activities in two basic ways. They either have some transactions in foreign currencies, for example, they may buy goods from international suppliers and pay in foreign currency, or they can equally have a foreign operation, which can be a subsidiary, associate, joint venture, or even a joint operation. So on top of that, any entity can decide to present its financial statements in some foreign currency other than their own. So the presentation currency can be different. And that's why there is the standard IAS 21. Its objective is to prescribe how to include foreign currency transactions and foreign operations in the financial statements. And this has something to do with the functional currency. And how to translate the financial statements into the presentation currency. So first, let me explain the difference between the entity's functional and presentation currency first. A functional currency is a currency of the primary economic environment in which the entity operates. So normally the one in which the entity primarily generates and expends cash. And you need to determine that in accordance to your own activities, environment, and operations. So in general, the functional currency is the same as the currency in the country where the company is located, but that's not always the case. It's basically the currency that influences sales prices, prices of goods and services, companies' labor costs, and so on. And it also really depends on the transactions of the specific entity. Sometimes it's not really clear what a functional currency is, and in this case, management must use its judgment to determine that. On the other hand, the presentation currency is a currency in which the financial statements are presented, and you can select a presentation currency. So it can be whatever you like. So basically, imagine there is a Mexican entity and this entity operates in Mexico. So majority of its expenses are in Mexican peso. And let's assume that therefore its functional currency is Mexican peso in most cases. Let's say that this Mexican company sells goods to German customer and as a result it has receivable in euro, which is a currency in Germany, and then the Mexican company needs to translate the amount of this receivable to its functional currency or Mexican peso. Now, let's say that this Mexican entity is a subsidiary of American parent company, and therefore Mexican company needs to provide financial reports to its parent. So Mexicans need to translate their own financial statements in pesos to presentation currency, which is US dollar in this case. Of course, Mexican company can present its financial statements in a different presentation currency too when needed. So how shall we report foreign currency transactions in the functional currency? Initially, it means when the transaction occurs for the first time, like the acquisition date of property, plant, and equipment, all transactions are translated using the spot exchange rate between the functional currency and the foreign currency. So the spot rate is the rate for immediate settlement, so the one that applies for actual transactions. Sometimes it's referred to as historical rate. Subsequently, at the end of each reporting period, we shall translate these transactions according to their nature. All monetary items like cash or bank account in foreign currency, receivable or payable, are translated using the closing rate at the reporting date. All non-monetary items carried at historical cost are reported using the exchange rate at the date of the transaction, that is historical rate. For example, property, plant, and equipment or intangible assets. All non-monetary assets measured at fair value in a foreign currency, like your investments carried at fair value, are reported at the exchange rate valid when the fair value was measured. How shall the exchange rate differences be presented? Well, in general, in profit or loss, but there are some exceptions. Non-monetary items with revaluation changes in other comprehensive income, well, the foreign exchange component of this change goes to OCI too. And a net investment in a foreign operation, that is basically entities' interest in the net assets in a foreign operation, that can be a subsidiary, associate, joint venture, or a branch. So here the differences are presented in profit or loss, in the separate or individual financial statements, and in other comprehensive income in the consolidated financial statements, and these are reclassified from equity to profit or loss when this net investment is disposed of. Now, how to translate the financial statements of foreign operation to the presentation currency? Remember, that's the Mexican subsidiary reporting to the US parent. Here, the very important fact is whether the foreign operations functional currency is in hyperinflationary economy or not. So let's deal with the most common case when it's not such a case. So again, it depends on what item we are translating. All assets and liabilities, including goodwill and fair value adjustments, are translated using closing rate at the date of the financial statements. Income and expenses are translated by the transaction or historical rate, but it can be impractical to translate each transaction separately, so the average period rates can be used as a reasonable approximation. In relation to equity items like share capital, share premium, and other items, well, IAS 21 is silent about it, and the rates to use are not specified here. The most appropriate seems using historical rates, but I've seen the usage of closing rates too. Anyway, it doesn't have any impact on the overall equity. Why? Because all resulting exchange rate differences shall be presented in equity as a separate component called CTD, or currency translation difference, or in some other way as appropriate. Now, when there is a currency of hyperinflationary economy involved, the entity should firstly restate its financial statements in line with IAS 29, financial reporting in hyperinflationary economy, and only then apply the same procedures as described here. So that was a very short summary of IAS 21. Thanks for watching this video, and if you want to take your IFRS and other knowledge a little deeper, then learn with me, sign up for our free newsletter at cpdbox.com. Thanks for watching. Bye.